The only way to be uniquely successful is do things that nobody else is doing and have them turn out well. You have to learn painful lessons in the investment business, and it's better to learn them early. It's hard to achieve singular success by joining the herd. Every once in a while, the market needs a trip to the shrink. But as long as we have humans involved in the pricing of securities, that will create fluctuations for the steady-minded person to take advantage of. If I were to describe how I got to where I am in life, I would say that I was conscious of the lessons as they arose. You know, one of my favorite sayings is that experience is what you got when you didn't get what you wanted. And you have to learn painful lessons in the investment business, and it's better to learn them early, but it's very important that you pay attention. What I've learned, and that was one of the great object lessons, was that in investing, the main way you gain unusual success is by doing things other people don't want to do. It's hard to, by definition, if you think about it mathematically, it's hard to achieve singular success by joining the herd. It's like a contradiction in terms, that if you do the same thing everybody else, you'll be uniquely successful. It's impossible. The only way to be uniquely successful is do things that nobody else is doing and have them turn out well. Of course, that latter point is important too. Just being a contrarian is not enough. I wrote a book in 2018 called Mastering the Market Cycle. And basically, it concludes that there will always be cycles because cycles arise from excesses and then corrections of the excess. And the excesses are usually emotional, psychological, whatever you want to call them. Economies don't fluctuate that much. Up 1, up 2, down 1, up 3. Companies fluctuate a little more, up 5 or 10 in profits or down 5 or 10, mainly because companies are subject to the economy, but they're levered. They have operating leverage and financial leverage. But stock prices fluctuate like mad, up 50, down 50, up 100, down 100, etc. Why so much emotion? People get too excited and then they get too depressed. And I wrote a memo called On the Couch around 2017 or 16, or 15 maybe, because I said that, you know, every once in a while the market needs a trip to the shrink. And I said there, or maybe in the next follow-up memo, which was called What Does the Market Know? I said that in the real world, things fluctuate between pretty good and not so hot. But in investors' minds, things fluctuate between flawless and hopeless. And when people think it's flawless, that's an excess, and it corrects because you shouldn't think that. But then the way people operate, it goes through reason and ends up at hopeless, which is also excessive. And the truth is usually somewhere in between. But as long as we have humans involved in the pricing of securities, I think we'll have excesses of optimism and pessimism. And that will create fluctuations for the steady-minded person to take advantage of. If I may interpose my view, the great challenge after you've done something unusual isn't figuring out when to get off it. It's figuring out how long you can stay on before it works. Because if you do something and it doesn't work for 6 months or for a year or for 2 years or for 3 months, might you be wrong? And commercially, can you endure, etc.? So this is the first challenge, not figuring out when to get off of a winner. That's a minor problem. Figuring out how long to stay with something that isn't working, that's a big problem. The first of the great sayings that I ever learned in the early 70s was that being too far ahead of your time is indistinguishable from being wrong. So remember what I said, to be an unusually successful investor, you have to see something other people don't see, or you have to see something differently from the way the masses see it. So you see something, you think this is better than most people think, you invest in it, but that doesn't mean they're going to change their minds the next day and say, you know, Howard, you were right, and bid it up. And that process can take a long time. How do you last? The answer is you need a strong stomach, good constitution, not too much emotion, and the resolve to stay with it. But, you know, if you stay with it for 20 years and it doesn't work, then you're an idiot and you're out of business. So there has to be some happy medium. there. Of all the books that have ever been written about investing and all the words, I would guess that less than 1% have been written about selling. They're almost all about buying, when to invest, what to invest in, how to choose what to invest in. When do you sell? Most people, I say half facetiously, I say that most people sell for two reasons. They sell things because they went up, and they sell things because they went down. They went up and they say, I better sell some because if it goes back down and I haven't harvested any profits, I'll kick myself and I'll look like an idiot. Or they buy it and it goes down and they say, well, I've bought it and I lost half my money. I better sell it before I lose the other half and I'll feel like an idiot. So a lot of selling is designed not to do the smart thing, but to avoid feeling like an idiot. Now, if you accept that people sell things because they're up and sell things because they're down, then by definition, they can't be both right. Because taking the same action in response to two diametrically opposed events, how can they both be right? And the answer is neither is right. You shouldn't sell things just because they're up, because if they were a good buy in the first place, maybe they have further to go. And you shouldn't sell things just because they're down, because if they were a good buy in the first place, maybe they're better now that they're cheaper. So selling because something's up or selling them because something's down, neither one is right on its face. There can be personal, situational reasons to sell, like you need the money, or, you need $10 million to retire and you're at 15. And if you go back to 6, now you don't have enough money. So there are legitimate reasons to sell, which are unrelated to the merits of the investment. But if you're free from those and you're just concerned about the merits of the investment, then obviously there's only one reason to sell, which is you reanalyze it. You examine your prior thesis. You look to see if your prior thesis is still correct. You look to see if there is still room for appreciation under your prior thesis. You maybe reformulate your thesis to update it. And then you say, is it an investment I would make today? And if the answer is absolutely not, then you probably shouldn't hold it. But, most people who are doctrinaire, who are, I would say, smug, say everything's either a buy or a sell. I don't think that's true. I think there are things that legitimately holds. That is to say, you bought it when it was 10. Now it's 20. You update your thesis. When it was 10, you thought it was going to go to 20. You update your thesis, and now you say, I think it can go to 25. Well, maybe you don't want to buy it for the trip from 20 to 25, but maybe you're feeling good enough about the trip from 20 to 25 that it's still worth holding. So there's some more juice in the orange.